Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. My name is Bryce, and as always, I'm joined by my equity buddy Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We are in part 3 of our 4-part series on the power and majesty and elegance of index ETFs.
That's it. This series is an educational collaboration between iShares by BlackRock, S&P Dow Jones, and NabTrade.
And Equity Mates.
And Equity Mates.
Because despite their growing popularity, we still think ETFs have a bigger role to play in a lot of people's portfolios as we all try and build wealth over the long term.
That's it. So if you're looking to invest in iShares ETFs, but you're not sure where to get started, visit blackrock.com.au/iShares for information about their ETF range, or visit nabtrade.com.au to explore further insights, education, and tips for getting started with ETFs.
Now, episode 1 of this series, we spoke about the growth that you get with index ETFs.
Yep.
Episode 2, we spoke about how you don't miss out on the incomes and the dividends from some of the bigger dividend payers in any market. This episode is about one of the harder parts of investing, a very common question we get here at Equity Mates, and about how the index structure takes care of it for you. It's all about knowing when to sell.
Yes. So today we're going to cover why indexes take that decision out of your hands, a reminder of how companies are added to the index, some notable additions, but more importantly, some notable subtractions. And we're going to be bringing in Sue Lee, who is an expert from S&P Global, to talk about the decisions that they make and actually the mechanics of the index. So I'm looking forward to that.
Let's start at knowing when to sell. It's one of the hardest things for investors to do, knowing when to cut your losers, when to take profits or to let your winners run, and also around position sizing and making sure that you've got the right balance in your portfolio. Well, luckily, if you're investing in an index, the product is designed to take that out of your hands, to take away that analysis paralysis, or just to let you invest without having to worry about that.
How does this happen? The most common form of an index is the market weighted index. And this is where you take the index, let's take the S&P 500, for example, the ASX 200, the Global 100, all of the indexes that we've been talking about today. All the companies within that index are ranked by size, otherwise known as their market capitalization, how big they are, the value that the market is putting on them. And then everything is bought, or the index is bought in relation to the size of that company.
So to give you a practical example, let's look at the ASX 200, which is IOZ by iShares. BHP, the Aussie mining company, is almost 10% of that ETF. And then National Australia Bank is just shy of 5%. Now, if we look at their market caps, BHP is worth $206 billion and National Australia Bank is worth $111 billion.
There you go.
So BHP is almost double the size of NAB, and in the index, it has almost double the weighting.
Yes.
And so that's how it works all the way down the list.
Yeah.
Yeah.
Now, every quarter, as companies get bigger, as companies get smaller, this process is repeated.
Yeah.
So as companies grow, their position and weighting within the index grows. And then as companies get smaller, some of them may actually fall out of the index as bigger ones replace them. And so this is the first, I guess, beautiful part of the mechanics of this is, unlike if you were managing a portfolio of individual stocks and trying to maintain position sizing and portfolio construction yourself, the index is actually doing it for you on a quarterly basis.
Yeah, so I guess the first takeaway, as companies get larger and others get smaller, the index ensures you're getting more of the larger and less of the smaller. You're getting more of the winners, less of the losers. And that structure of market cap weighting and index, a lot of jargon in that sentence, but that structure over time has proved to be really effective. When you look at the performance of an index over time or you back test it, it's done well.
Yeah.
And so the great thing as investors is we get that structure without having to do any of the work.
Yes, yeah. I think the key thing there is the terminology used there, which is what's nice to remember is you get more of the winners, less of the losers. It's not like that you're just getting more of bigger companies. The way to think about it is, you're not having to pick the winners here. You're just getting them as they rise.
Yeah. So that's about the size or the weight of these companies in the index. But the real beauty of the index product is who's added and who's taken away.
Yes.
So let's take a look at some additions of the American S&P 500, which is the IVV ETF. So since 1976, tell me if you recognize any of these names.
Okay.
Apple was added in 1982.
Nice, yeah.
Microsoft was added in 1994. Amazon was added in 2005. Netflix was added in 2010. Tesla was added in 2020.
Nice.
So as those companies listed and emerged and grew, they then get added to the index.
Yes.
And this sort of harks back to what we were speaking about in the first episode of this series, all about like you capture the growth of these new companies coming through and driving the index forward.
Yes. Well, let's put some numbers to the growth story from these companies that were added. Apple is up 105,000% since it was added in 1982. Microsoft is up 8,500% since it was added in 94. Amazon is up 4,000%. Netflix is up 4,000%. And Tesla is up 300% since 2020. So you can see the incredible growth that these companies have contributed to the index. And not only that is by holding the index yourself, you wouldn't have had to have individually chosen these stocks. You would have been the beneficiary of this growth as the companies move up.
All right, well, so far we've just spoken about winners, just spoken about the big companies that have joined the index and pushed it forward. That's not what we set out to do today, though. We set out to talk about cutting your losers and knowing when to sell. But the flip side of these winners that were added is that for every winner that is added, a loser, well, a smaller company is removed.
Yeah.
And so we can look at some of these big names and see who they were substituted for. Now tell me if you recognize any of these names.
Okay.
So when Apple was added to the S&P 500 in 1982, Amalgamated Sugar Company was removed. Heard of it?
No, I haven't.
What about Microsoft was added in 1994? Syntex Corp was removed.
Nope.
Okay. Netflix added in 2010. This is more recent. Surely you've heard of this one. King Pharmaceuticals was removed.
Cannot say I know it.
And that is really the point, that the structure of these products is that you get more of the growing winners and then companies that can't keep up. It's not even that they're getting smaller necessarily.
Yeah.
It's just that they can't keep up with the pace of growth of the 500 biggest companies in America or the 200 biggest in Australia.
Yeah.
They get left behind, they get cut out, and you no longer hold them in your portfolio.
Yeah.
So that is, I guess, how you cut your losers and how you're constantly trimming your portfolio to have only the best of the best, those that are big enough and growing fast enough to sit in that top bracket, but you do it without having to actually do any of the work.
Yeah, you don't have to worry about when to sell.
Yeah.
It literally does that for you.
Yeah.
It's beautiful. And these products are designed for that long term. We use them in our core portfolios for 20, 30, 40 years. So the question is here not knowing when to sell IVV or IOO because the internal buying and selling is done through the mechanics of the index.
Yes.
It's amazing.
Well, let's pause here before we look at the Global 100 Index, IOO, and say a massive thank you to our sponsors for this series, iShares by BlackRock, NAB Trade, and S&P Global.
If you're feeling overwhelmed with what to invest in and which companies to pick is a source of stress, then don't worry. We've all been there. With iShares S&P ETFs like IOZ, IVV, and IOO, you can get low-cost access to hundreds of the world's largest companies in a single trade to help diversify your portfolio and help reduce the stress.
S&P Dow Jones Indices does not sponsor, endorse, sell or promote any product based on an S&P Dow Jones index, nor does it make any representation regarding the advisability of investing in the products. Before making any investment decisions, you should assess whether the product or service is appropriate for you and read the PDS and TMD available at blackrock.com.au.
So, Ren, we've spoken about the S&P 500 or IVV. Let's take a look at the S&P Global 100 or IOO. What are some of the companies that have been booted out?
Well, I think because the Global 100 is a bit less known, and it's really it's not necessarily the 100 largest companies in the world, but it follows an index of 100 big multinational companies. That's kind of what it's trying to follow. And I think, again, you can see as the economies change, as different companies come up over time, and I guess different companies better fit that bill of blue chip multinational companies, like the true global giants. You see that reflected in the change of the index. And what that means is you don't have to do the work of deciding which companies best fit that bill. S&P Global do that work for you, and we're going to speak to one of their experts in a bit. And your portfolio is just the 100 companies that best fit that bill at any one time. So let's put some practical examples to that. Let's go back to 1997 when Microsoft was added to the Global 100.
Yes.
It replaced a company called 9X Corp. I'm not even going to ask you if you've heard of it. Procter & Gamble, the consumer products giant, was added in 1998.
Yeah, I was surprised about that. I thought it would have been added earlier. There you go.
Yeah. Replacing digital equipment. Pfizer, the pharmaceutical giant, was added in 2000, replacing Fluor Corp, Fluor. Doesn't matter about spelling it. And then finally, Starbucks, the coffee chain, was added in 2012, replacing Avon Products. So again, if you're thinking about, I want a portfolio of like massive multinational companies that make money around the world, the companies that are getting added certainly fit that bill more than the companies that are being sold off and replaced.
To reiterate the point here, we started out by saying one of the most common questions that we get is knowing, well, when should I know when to sell? Or when do I sell? What are the key characteristics? And the beauty of these products is that you don't have to worry about that decision.
They're designed to take that out of your hands.
Yes, take that out of your hands. Even the decision to what to buy equally is taken out of your hands because of the movement and the mechanics of the index. But Ren, I think that's a great spot to bring in our expert from S&P Global. We've never had anyone on the show from one of these index makers. So really excited for this one. We're going to bring in Sue Lee to help us understand a little bit more about how these indexes actually work. Let's bring her in.
So we're joined by Sue Lee, the APAC head of index investment strategies at S&P Dow Jones Indices. Sue, thanks for joining us today.
Hello, thanks for having me today.
Now, so this is actually the first time we've had a representative from S&P on the podcast, so it's exciting for us. So can you help us understand the role of S&P Dow Jones Indices in markets and in building indexes?
Absolutely. So we, S&P Dow Jones Indices, are an index provider. We design indices, maintain, and calculate them. Millions of indices are being calculated every day. So indices are used by many financial professionals and investors, mainly in three ways. First, tracking and analyzing market performance. So you read and hear from financial news that Austrian market measured by the S&P ASX 200 went up or down a certain percentage point. So you know where the market is heading and how much real time the index data is being used as inputs for investment economic decisions. And second, indices are used for evaluating portfolios. You benchmark the Australian large cap equity fund you hold against the S&P ASX 200 and see how much alpha the fund has generated versus the market. And then lastly, the third, index-based strategies. Indices are used as a basis for index tracking, so-called passive investment products. For example, the S&P ASX 200 is used for index futures, index options, or index ETFs. In addition to broad market indices, we provide more complex and innovative index solutions such as factor, risk control, option-based, and multi-asset indices. So Through this process, we as an index provider bring transparency to the market and inform market participants to help them make better decisions. We also support our clients, such as asset managers, financial advisors, and to help them use our indices more effectively by providing analysis, research, and education. So that's the gist of what we do as an index provider and how we serve the market.
Nice.
Yeah, and if any equity mates listening want to just see the range of indices out there, it's fascinating to go to the S&P Global website and just see how many different indexes there are and how many different things can be tracked.
Absolutely.
It's pretty overwhelming.
That's wild.
Indeed.
Now, Sue, you mentioned there part of what you do is design, maintain, and calculate indices. So we want to dive into the design component a little bit to start with. We've been talking about the Global 100 a bit in this episode. So can you help us understand the process that you go through for selecting companies that go into the Global 100? What factors are used for inclusion, exclusion, and what do you think about in the design phase of an index?
So in general, index constituents are selected based on quantitative or a combination of quantitative and qualitative measures in line with the index methodology that is publicly available. So there is an index committee who ultimately decides the addition and deletion of stocks to make sure that index delivers what it is supposed to deliver. So for the S&P Global 100 index comprises 100 multinational blue chip companies whose businesses are global in nature and delivers a substantial portion of their operating income from multiple countries. So companies are screened for global exposure, meaning more than 30% of a company's revenue and asset should be coming from outside of the company's country of domicile. And in addition, we'll also consider size and liquidity and sector balance. So the index committee considers all these factors and decides which stocks to be included in the index so that the index represents the current market and the current trends. So there were about 8 pairs of additions and deletions over the past 1 year. Without giving you specific names, 5 of the additions were the US stocks, and 4 of them were from information technology sector. So being reflective of the recent strong performance of the US stock market as well as technology sector.
Now, so one thing that we've been talking about in this particular episode of the series is how the design of an index product allows you to capture the stocks that are growing more quickly and making their way into the index or becoming a bigger part of the index, and I guess cutting some of the slower growing or shrinking stocks through the rebalance process. So can you just talk a little bit about how that process happens from your perspective, how often they're reviewed, and then how these indexes are rebalanced?
The index rebalancing happens differently for every index. So some indices like S&P ASX 200 rebalances on a quarterly basis. We know which date it happens, but the case of S&P Global 100 index, there is no regular schedule of index rebalancing. But as I mentioned, there's index committee that meets regularly to monitor all the corporate actions and significant market events, so that to make sure that the index remains consistent with its objective. Yes, in case of S&P Global 100, there is no set schedule, but as I mentioned, there were about 8 pairs of additions and deletions over the past year.
So we just would love to get your view on the rise of passive investing and how it's influencing the demand for not only the Global 100, but the other 2 major indices that we talk about, S&P 500, ASX 200. How are you seeing the rise of passive investing?
Yes, the rise of passive investing or index-based investing is one of the most prominent trends over the past few decades that fundamentally changed the asset management industry as well as how people invest. So, according to Morningstar, asset tracking passive funds surpassed that tracking active funds at the end of 2023 due to the advantage of index-based approach, including low cost, transparency, ease of trading, and most importantly, better long-term financial performance. So this means there are a lot more money tracking indices through various investment vehicles, and there are a lot of trading activities around indices, resulting in increasing significance of indices in the market infrastructure. So the S&P 500, as you mentioned, is a great example, which has more than 10 trillion US dollar asset tracking at the end of 2023, and total value of over 220 trillion US dollar traded over the course of 2023, based on our estimation.
Wow.
It is just amazing the scale that indexes and index ETFs have taken on over the past few decades. But I think, Sue, as you said there, lower fees, more transparency, and better financial performance. There's a few big reasons why the index-based investing has become so popular. And we really appreciate you coming on the podcast today and helping us understand it a little bit better. And I think in particular how it works from the index providers side of the fence. So thank you for joining us today.
Thank you very much.
Well, a massive thank you to Sue Lee for joining us on the podcast. I certainly feel like I understand indexes better, and I certainly still believe they're underappreciated and elegant.
Yes, get around them. We would just like to say a massive thank you to iShares by BlackRock, NAB Trade, and S&P Dow Jones Indices for supporting this series.
Are you looking to invest in ETFs, but you're not sure where to get started? Visit blackrock.com.au/iShares for information about the iShares ETF range available in Australia, or visit nabtrade.com.au to explore further insights, education, and tips to get started with ETFs.
S&P Dow Jones Indices does not sponsor, endorse, sell, or promote any product based on an S&P Dow Jones index, nor does it make any representation regarding the advisability of investing in the products. Before making any investment decisions, you should assess whether the product or service is appropriate for you and read the PDS and TeamD available at blackrock.com.au.
Now, join us next week for our final episode in this 4-part series, where we're going to be talking about how indexes allow for truly timeless investing.
Yes.
Why the set and forget long-term investing mantra is embodied in these products.
I love it. Well, stick with us. We'll be back in the next episode.
Equity mind.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.